Good morning, everybody, and welcome. We are live here at Benzinga. Today is Thursday, the 18th of September, 2025. I'm Gianni DePoce, your host, and I'm joined today by Sean Edwards of Direxion. We're going to be talking about interest rates, Fed meetings, and more, and how to use leveraged ETFs to boost your returns in this market environment. Very exciting time. Stocks are hitting new all-time highs, fresh off the Federal Reserve's first interest rate cut in about 9 months yesterday. So there's no shortage of things to talk about, no shortage of opportunities, and I'm very happy to be joined by Sean. So let's go ahead and bring him on. Sean, how you doing today?
Good, Gianni. Good to see you again. Thank you for having me once again.
Oh yeah, it's great to have you back. You got a new setup, don't you?
We do.
Yes,
I think talking with you guys has helped us out. So definitely a new setup. So apologize if any sort of technical difficulties, but I think we should be good.
Right on. So we got a lot to talk about today. I'm seeing a lot of very interesting setups in this market. I'll save that for just a moment, but I know that you'd like to tell us a bit about how these products work. So why don't we get started with that?
Oh, sure. Thank you. Well, awesome. No, again, thank you all for having me. No presentation will be complete without our disclosure. So feel free to read through that, but we can move on to the next slide. So just as a background, for those who are unfamiliar with Direxion, we are an ETF issuer. However, we're primarily a leveraged and inverse ETF issuer. This slide here just showing you our inception, our growth, and I'll just provide a little more background on who we are. So again, a leveraged and inverse ETF issuer. If you look at the chart here on the screen, you'll see that our assets and the number of ETFs that we've launched since 2008 have grown over time. Right now, our assets are around $55 billion. So we're a top 20 ETF issuer by AUM globally. So as I mentioned, and what Gianni will discuss a little bit more, is that we have leveraged and inverse ETFs. I'll talk through the education and the nuance of our funds in a few additional slides, but just high level, our leverage and inverse ETFs, they are not traditional core ETFs. I always like to say, think about it just simply. We are a motorcycle where your traditional core ETFs are minivans, right? So there's some risk when you're riding a motorcycle. If you ride a motorcycle with your helmet off, there's even more risk. So for those traders that have that appetite for risk, we have tools for you. So once again, leverage and inverse ETF, these are tactical short-term trading tools. Again, I'll talk through the details in a few additional slides. But as a firm, as I mentioned, our assets are around $55 billion in AUM. We have over 100 leverage and inverse ETFs. Whether you're bullish or bearish, a particular index or an individual stock, which we'll talk about later, you can express that conviction. So we have offices here in New York City, Hong Kong, Milwaukee, and Boston. And we can move to the next slide. So as I mentioned, leverage and inverse ETFs. If you look at the leverage and inverse ETF marketplace, there are over 250 ETFs. Right now, as I mentioned, we're a firm with assets around $55 billion. The total market space for leverage and inverse ETFs, it exceeds $100 billion in assets under management. So for those traders who are bullish or bearish within 3X or 2X strategies, you can look at this chart as it gives you an idea of where you see assets flowing. So right now in the 3X bull space, the 2X bull space, and you see within the chart as well, you see inverse exposure, inverse 1X, inverse 2X, inverse 3X within different market exposures. So if you are interested in broad market indices like the S&P 500 or the NASDAQ 100, you could look at leveraged ETFs to get that exposure. If you're looking at particular sectors like tech or energy or financials or fixed income, which Gianni, I know you mentioned that you'll talk about a little bit later as well. You can look for that exposure. Industry-specific themes like semiconductors or biotech or even single countries, you can look at leverage and inverse ETFs to get that exposure. We launched back in 2023 single stock ETFs, where instead of your index exposure, you can get exposure on single stock names such as Tesla. And we'll talk through those a little bit later as well. And we can move to the next slide. So once again, for traders that are interested in expressing conviction, you can look at utilizing leverage and inverse ETFs. So leverage and inverse ETFs allow you to magnify returns of a benchmark index or a single stock on a daily basis. So of note, you should not expect that exposure for periods longer than a day. So within all of our funds, you see that the exposure, it has a daily in front of that exposure. So for example, the daily S&P 3X Bull ETF, just simply signifying that if you're looking for enhanced exposure, it's just going to be for a single day. So you should not expect 2x or 3x exposure on that index or single stock for periods longer than a day. Just breaking this down a little bit further, the exposure is just simply meaning, hey, if you invest $1 in this particular fund, you're getting $2 or $3 worth of exposure. If you're in a 2x fund, that's $2 worth of exposure. If you're in a 3x fund, you're getting $3 worth of exposure for that dollar invested. Bull just simply meaning you're bullish, so you believe that that index is going to go up, and bear meaning bearish, meaning that you believe that index is going to go down. So to get that enhanced exposure, you may ask, how do we do that? We use ETFs or a basket of individual stocks that replicate an index and a swap to give you that enhanced exposure. So that's what you'll see on this slide where it says fund makeup. It's simply going to be a combination of equities and derivatives. So the equities would be the ETF or a basket of stocks plus a swap. And that's how we provide the enhanced exposure. And we can move on to the next slide. Excuse me. And so this is probably the most important slides, or one of the most important slides. So as Gianni will tee up later, he'll provide you with a few different tickers that you could trade and setups that you'll look at. But it's going to be really important to understand the foundation of leverage and inverse ETFs. And that foundation is just simply compounding. As I mentioned before, you should not expect to see that 2x or 3x exposure for periods longer than a day. The next few slides, I'll explain why. Excuse me, 1 second. So on this slide, I encourage you to screenshot it. If you have not, I'll simply explain this slide. Ultimately, it's just expressing that compound is going to work for or against you depending on the underlying trend. So these numbers show that simply, if you're holding any of our funds for periods longer than a day, the underlying index trend or single stock trend will be extremely important. Let's walk through this slide a little bit just to really drive home this point. If you look at the very top of this screen, in dark red, you'll see that it says that this is a hypothetical example of compounding on a 3x fund. So let's just keep it really simple. Let's just say we invest $100 into SPXL. So SPXL, that's a 3x bull ETF on the S&P 500. So if we're investing in SPXL, we're believing that the S&P is going to increase. If our original investment is $100, our initial exposure is $300. As I mentioned, for our leverage funds, $1 invested equals $3 invested. So in this case, $100 invested is equal to $300 invested in this fund. So let's just say we invest $100 in SPXL and the S&P increases 5%. That means our ETF SPXL would increase 15% on the day. That's just the basic math. 5% times 3, it's a 3x fund, is 15%. So our ending day assets are 115. So that's a pretty good trade. So our end of day exposure is $345. And so the total return on the day is just 15%. But let's just say the second day, instead of the S&P increasing, it falls. So we start the day with 115, but the index falls 5%. That 5% multiplied by 3 is 15%. that 15% compounded will bring you below your original investment from day one. So again, day one, the index rises 115. The second day, the index falls 15%. That is compounded. And so your original investment of $100, you see that it's going to, after this compounding, the index falling 5%, you'll be below your original investment. So hopefully that drives home the point of just compounding. If you're holding any of our funds for periods longer than a day, you should not expect to see that 3x or 2x performance for periods longer than a day. And we can move to the next slide as it will further drive home the point. So you'll see here in a trending bull market that compounding can work for you. If you look at this slide, you'll see the benchmark index return over a period of 7 days is 11.4%. So 11.4 times 3 equals to 34.2%. But if you're in a 3x bull ETF over this time period, you'll see that your benchmark's return is going to be 37.3. So that's more than a 34.2% return that if you were to invest in this fund over that time period. You'll see that it's simply saying that compounding works for you in this case because the trend is clear into the upside. In the same way, if you're looking at a 3x bear ETF over this time period, you'll see that your return is a negative 28.7%. That's less than a 34.2% return if you were to just hold the benchmark ETF over this time period. So again, simply driving home the point that compounding can work for or against you. If during this period you're in a 3x bull ETF, you would have gained more than the benchmark cumulative return multiplied by 3 during this time at 37.3. And the same could be said, again, compounding working for you if you're in a 3x bear ETF, although the benchmark is clear into the upside. If you're in a bear fund, obviously, you want the index to be to the downside. In this case, you don't have a loss that's as much. And we can move to the next slide. So this slide here is just simply showing that, again, compounding works for or against you. The trend is your friend. We saw that in the previous slide. But let's just say the trend is unclear, sideways, and choppy. What you see over this time period, the benchmark's return is 2.4%. So if you're in any leverage product, in a 3x leverage product, that benchmark's return would be 7.2%. So again, looking at this chart, you see over this time period, if you're in a 3x bull ETF, you're up only 6.3%. Whereas in the previous side, you had excess returns over the time period in a bull fund. In this slide, you see because the underlying trend is choppy and sideways, that it worked against you. So instead of having a benchmark cumulative return that was at least 7.2%, you'll see you're below that at 6.3%. And then in a bear fund, you see, once again, that compounding is working against you because the trend is not clear. So you see the benchmark return is 2.4. The cumulative return will be 7.2. But in this case, the 3x bear ETF is down 8.6%. So in excess of the benchmark's cumulative return during this time period. So once again, these last 3 slides are just simply showing that compounding can work for or against you depending on the underlying trend. And we can move to the next slide. And so as traders that may be unfamiliar with how to utilize leveraged ETFs, what you'll simply see is that leveraged ETFs are for opportunistic trading. If you are a trader that has conviction on a particular index or single stock, you can look to utilize leveraged and inverse ETFs. And Gianni will talk through some of those use cases later on in this presentation. So whether you want to express further bullish conviction utilizing our 2x or 3x bull ETFs, or if you want to hedge, you can look at utilizing our inverse ETFs. So you'll see our inverse ETFs. It's inverse 1x exposure in some cases, all the way through inverse 3x exposure. So again, it's portable alpha trading. So for $1 invested, you have 2x exposure or 3x exposure. And so again, with the volatility that we're seeing in the market so far this year, around interest rates, around geopolitical issues, again, we have 100 different ETFs, over 100 different ETFs, whether they're sector specific or broad index specific. You could look at trading our leveraged and inverse ETFs. And we'll talk through a few use cases further, but I want to spend a few moments highlighting our leverage and inverse single stock ETFs. And we can move on to the next slide. Here. And excuse me, I'm just coming over a cold, so I apologize for drinking. So once again, our leverage and inverse single stock ETFs. So as a franchise, our leverage and inverse single stock ETFs are now surpassing $11 billion in assets under management. So on this slide and the next slide, you'll see just a few of our leverage and inverse single stock ETFs. So as I mentioned, you have traders who want to trade single stocks, but they want enhanced exposure to those single stocks. The max exposure that you'll have here will just be 2x. So for those traders that want to express further conviction, whether it's around earnings or just company-specific information, you can look at our leverage and inverse single stock ETFs. What you'll see is that we provide 2x exposure if you're bullish and inverse 1x exposure if you're bearish. And so those will be on key names that we're all familiar with. So the Mag 7, semiconductors, and other industry leaders like healthcare, or industrials like Boeing, and healthcare like Eli Lilly. You'll see Mag 7 names like Tesla, Apple, Amazon, Alphabet, Microsoft, Meta, semiconductor names like Micron, what you'll see here, Taiwan Semiconductors, Broadcom, and NVIDIA. So for those traders that are looking to trade volatility around earnings, tariffs, geopolitical issues, you can look at leverage and inverse single stock ETFs to trade those price swings. And again, these are tactical short-term trading tools meant to be monitored daily, as the previous slides showed. If you're looking to trade our leverage and inverse ETFs, you have to make sure you monitor them daily, in some cases intraday, depending on the volatility within that underlying index or single stock. And we can move to the next slide.
We do have a good question in the chat here, Sean. It's from
Sure.
Black Mamba. Black Mamba is asking, could you clarify the benefit of 1x inverse versus shorting a stock?
Sure, that is a great question, Black Mama. And that reminds me of Kobe, so thank you for that. But no, inverse single stock ETFs, what's the benefit versus shorting? Well, we know if you short, it's going to be more expensive. You have unlimited risk, and there's margin required. So you may not be in a position to, one, have the unlimited risk or to have a margin account. If you want to hedge those individual names, you can simply use an inverse ETF. It's in an ETF wrapper. It's easy to trade. You don't need margin. It's not going to be as expensive. You do not have the unlimited risk if you were to simply short. So that is the benefit.
Great. Thank you for that.
No problem. And any other questions, keep them coming, as my portion of this presentation is going to end shortly, but happy to answer any other questions that may be in the chat.
I think that takes care of all the questions. Did you have any more in your segment here, Sean?
Just one more slide, and these are just a follow-up for those who have any questions about education around our leverage and inverse ETFs. You can go to our website, so www.direxion, Direxion.com. We have a robust library of educational content So that includes articles and market insights, explainer videos, and an ETF university. So for those who are unfamiliar with leverage and you're starting from ground zero, you can utilize that interactive learning tool to test and build out your leverage ETF knowledge before placing a trade. So a great resource for both new and experienced traders looking to deepen their knowledge and their understanding of leverage and inverse ETF strategies. So again, questions like, hey, what's the benefit of inverse ETFs versus, shorting? Or what's the benefit of leverage ETFs versus options trading? Or how will corporate actions impact leverage ETFs? We have those answers. So if you have not already got familiar with our website, I would encourage you all to go to our website, go to our ETF Education Center, and become more familiar with leverage and inverse ETFs. You can also, go to our info page and ask any additional questions that may be more complex. And we have a team here that's happy to help. And that is all I have on my end, Gianni.
Yeah.
And again, thank you guys.
We do have one more question.
Sure.
From Black Mamba, once again, are there plans for 5X ETFs?
No 5X ETFs, Black Mamba. There was a rule back in, I believe, 2023, or a ruling from the SEC that said the leverage ETF maximum exposure moving forward in the US is just going to be 2X. We're grandfathered in. If you go to our website, you'll see that we have still a robust suite of 3X ETFs, but moving forward, there will be no 3X leverage ETFs, not just from Direxion, but all leverage ETF issuers within the US. So wow, again, great question.
Yeah, that's actually pretty remarkable to know because, back, this is probably like 10, 12 years ago, I was trading these leveraged ETFs quite a bit, especially in the gold mining space. And I thought, I remember the ticker symbols JNUG and JDST being 3X, and now they're 2X.
They were 3X, but due to the volatility that took place during the pandemic. So you see, we made that change to reduce the exposure from 3X to 2X. As I mentioned a little bit earlier, going under the wrapper, we're utilizing swaps. So it became a little, more difficult to manage that exposure. We had very large premiums and discounts within our ETF. So those traders that thought they were buying at one price, because of the volatility that took place, there were very large premiums. So you thought you were maybe buying one of our leverage funds at $10 and you wind up buying at $20 just because of the massive premiums. So we had to reduce the exposure on a few of those ETFs, and JNUG, as you mentioned, Gianni, were one. So no more 3X there. There are now 2X exposure, maximum exposure for those funds.
Do you ever see any traders using options on these leveraged ETFs?
Yes. So for those exposures that can stomach the risk. So again, it's almost like driving a motorcycle without a helmet. Yeah. That's a lot of risk that you're taking on. Some are able to do it, and kudos to them. Yeah. But it's we have seen traders that want that enhanced exposure to the underlying index or single stock. So there are traders that are utilizing options on our leveraged funds.
Awesome. All right. Well, thank you so much for that, Sean. It really helps us kind of set the stage for what I'm going to talk about next, which I think are the best opportunities amongst your suite of ETFs. I'm in this market all day, every day. This is what I do for a living. I love what I do. I love sharing the knowledge of the markets with fellow traders. And I do this all the time. And I've been doing it a while. And I don't think with the way the markets are now that it's going to be slowing down anytime soon. So like I said, we came into today, Federal Reserve just cut interest rates for the first time in 9 months. You have stocks hitting new all-time highs. You have precious metals. Gold hit a new all-time high earlier this week. Silver, 14-year high. And even bonds. You've seen interest rates come down even on the longer end of the curve. Some of those bonds with longer maturities. We've seen a rally in bonds. Now they're actually coming back down. And so there's so many short-term opportunities. And I want to draw your attention to where I think the best ones are in terms of trading right now. So let's go ahead and jump into it, starting off with semiconductors. Semiconductors are very well known to be a leading indicator for the overall market. And what I have here is actually the semiconductor index. So as Sean was talking about, when you're looking at some of these sector-oriented or country-oriented leveraged ETFs, they follow an index of the sort. So I'm looking at a semiconductor ETF here, and I do have a chart going back pretty much to the beginning of the year. Now, I'm showing a chart that goes back this far because I want to illustrate the importance of the trend. Sean mentioned a very common but very important phrase that is thrown around in trading circles. The trend is your friend. And I like to say the trend is your friend until the trend ends. Well, how do you know when a trend is coming to an end? We'll talk about that in another day sometime. But for now, let's just focus on the state of a trend. The reason why you need to know what direction the trend is going in any particular index or stock or market is because the greater magnitude moves will happen in that direction. Meaning, if you see an uptrend in an index or in a stock, you're going to get bigger moves to the upside and smaller moves to the downside. And as a trader, I'm all about probabilities. So if I observe an uptrend in an index, I'm going to be looking at opportunities to buy stocks or buy these leveraged ETFs on the long side because the greater move is going to be in that direction. So when it comes to trends, let's just start off with an uptrend here, okay? Semiconductors, higher highs and higher lows. It's really that simple. So this is why I have a chart going back this far, because if you just look at, a chart that is 1 month long, you're not going to get that good of a feel for the direction of the trend. And, as Sean showed you, if a market or an index is experiencing a choppy trend or a mixed trend, as I like to call it, it's kind of hard to trade. So you want to know, you want to be able to zoom out. There's another phrase in this trading world, when in doubt, zoom out. That doesn't mean you're necessarily taking entries based on the longer term chart, but it does help you get a better sense of what direction the trend is going. So here you're seeing, and semiconductors, we've been trending higher since the April lows. We just hit a new high, broke out from this pattern. I'll be talking about some of these patterns in just a moment, but I do want to start off with just understanding the importance of the trend. On that note, what would we be looking to do, or how would we be looking to position ourselves in the semiconductor sector right now? Well, like I said, for me, I'm a trend trader. I'm going to trade in the direction of the trend, which means when it comes to semiconductors, my primary focus is going to be on SOXL, okay, the triple leveraged semiconductor bull ETF, okay? So since April, this thing's been on fire. Now, we're not holding these funds for a period of time. Now, when I use these ETFs, I'm trading them for a couple days at a time. So like Sean said, it is absolutely critical that you are able to monitor these positions. I would even say on an intraday basis, okay? Because the leverage works both ways. It can be very rewarding or very cruel. So I think that these are things that you need to be able to monitor on a daily basis. In this day and age, it's easy. Just put it on your stocks app on your iPhone or whatever, just as long as you can keep track on this of this stuff. And one of the things I like to do with my broker is set price alerts. If you need to step away and you carry your phone with you, have price alerts from your broker be sent to your phone. It's so important because when these things turn, they can turn quickly, and you don't want to let a big gain evaporate. So SOXL here, you did form a higher low back at the beginning of this month. If you compare it to the low in August, the two lows in August, it was higher than that, definitely higher than the low that you had in June, and you broke out to a new high. Now, I do want to talk about the patterns a little bit and kind of just introduce them at a surface level. And by the way, Sean and I have been doing these sessions now a few times here and there throughout the year. And I do have some of the patterns that we discussed in previous sessions still on some of these charts, just so you can see and so I can illustrate the power and the importance of these patterns. I'm going to be very clear. I think this is a very important part of your education as a trader, being able to identify not just trends, but taking that understanding to the next level with patterns and tools such as support and resistance. I think that really is the crux of being a trader in the year 2025. Chicago doesn't even have trading pits anymore. If you want to trade in the pit, you got to go to New York, where Sean is. And even then, I don't know how much longer those are going to be around because everyone's trading electronically nowadays. So this pattern that we see here on the semiconductor ETF, the SOXL, is an ascending triangle. These are known to be continuation patterns. Continuation of what? Continuation of the trend. So you see how the trend really is the foundation of understanding how to analyze charts in this business. Even if you want to trade against the trend, you need to know what the trend is to trade against it. So it doesn't matter what side of the market you are trading, you need to be aware of what's going on at the trend level. So we broke out from this triangle. Are we going to see a continuation higher? Well, it would seem that way, but what could go wrong? You always need to be asking yourself that question as a trader, no matter whether you're bullish or bearish or neutral. What could go wrong? And at what point am I willing to admit that this trade is not working out and I need to get out of Dodge? Okay. Now, SOXS is the triple inverse semiconductor ETF. Okay. So here what you have is a trend line, a pretty clean trend line, downward sloping. And, you know, I'm actually not one of those traders that falls into the camp of thinking that once a trend line is broken, whether it's sloping to the upside or sloping to the downside, when a trend line is broken, I don't think it means the trend changed. On the contrary, I need to see either higher highs or higher lows coming out of a bear trend, or lower lows or lower highs coming out of a bull trend. When a trend line breaks, like we see on this chart, if it were to break, it would just mean the rate of descent or the slope of the decline that's been in effect is no longer in effect. So important to have your definitions correct and that we're on the same page. There's a reason why Direxion has a glossary of terms for everything that they, you know, all the vocabulary that they're using, because we need to make sure we're understanding things in the same way. So what could go wrong in the semiconductor trade? Well, trade wars with China, you know, more chip embargoes along the lines of NVIDIA. You know, there was even some news yesterday where, hey, you know, China might not let NVIDIA sell some of their chips within their country. So there's a lot of things. It's a very delicate rally that we're seeing in chips. But as the saying goes, a bull market climbs a wall of worry. And what's beautiful is that you can always protect yourself if you're long any individual stocks in the semiconductor space with this ETF right here, SOXS. All right. So I think right now the more bang for your buck is going to be on the upside in the semiconductor space. But in the event that we get a dip, there could be some opportunities to either hedge existing semiconductor positions or even take a swing on the bear side in that space. Now, I want to talk about what I think is the biggest opportunity in the world right now when it comes to a country at the equity level. I think it's in China. Now, if you've been paying attention to the Chinese market over the last few years, it's struggled. It struggled big time. Year to date, we've seen international stocks have quite a run. European stocks across the board have done exceptionally well. You know, you've seen some Asian markets do well. The U.S. has actually lagged behind quite a bit. I mean, the S&P is only up, what, 11, 12% year to date. Compared to previous years, that's not that exciting. Compared to the previous decade, it's kind of average, all right? But China has been stealthily outperforming the S&P 500 year to date, and even last year. It's just one of those outperformances you have not been hearing about. But I think that's going to accelerate even more. I actually believe that rate cuts in the United States benefit the country of China. I tend to be a bit more optimistic than pessimistic over the state of the world. I know that's not popular if you're on the internet. Everything has to be the end of the world, doom and gloom. Well, sometimes I like to fade that. Maybe it's the trader in me that likes to go against the crowd sometimes. But the opportunities that I'm seeing in China, this needs to be on your radar. And we're just looking at the FTSE, the FTSE China 50 index in this case. It's the index that many of the or the two triple leveraged bull and bear Direxion ETFs for China. It's what they track. And since April, you've had quite a rally. But again, China's been stealthily outperforming the United States year to date, and I don't think that's slowing down anytime soon. I do want to talk about support and resistance for just a moment. So what I have here, these two green lines, it's a range, it's a zone on a chart. This was resistance. Now, there's a lot of theories that circulate out there around economics and markets or whatever, but what I love about support and resistance is that it allows us to visualize supply and demand in real time. So honestly, I love economics. I could, spend a whole day talking about macroeconomics, but a lot of it is kind of a sideshow in the main event. The main event is really just a price action, but supply and demand is very real. And when it comes to resistance, resistance is a zone or a range on the chart where supply exceeds demand. Typically, when supply exceeds demand, prices stop going up or they go down. On the inverse side of that, support, which I'll have some examples of in a moment, is an area on a chart where demand exceeds supply. And typically, prices will stop going down and even start rising there. So what happens when resistance breaks? Well, that tells you that demand has exceeded supply. And when demand exceeds supply and resistance breaks, that resistance becomes support. So very important to understand, because now you've had this big break above this triangle pattern, like I showed in the semiconductor chart a moment ago, and you also broke an important resistance level. So if anything, we're seeing momentum into China accelerating to the upside here. It's very, very exciting. Now, we know there's a lot of things that could go wrong. There could be new tariffs. I think there was actually an announcement earlier today that said we're looking at extending the trade negotiations with China and exempting a lot of the tariff stuff. The goalposts are always moving. It's honestly pretty hard to keep up on all that news, which is why I prefer to use the charts. I prefer to use the price action. Price knows first, news knows second. Okay. Remember, sentiment follows price, not the other way around. That's why I like to use these technical studies that I'm explaining right now to help me make my decisions when it comes to trading. So here, it's very clearly a downtrend in Yang. The 3x bear China ETF, lower lows and lower highs. That's not been the trade in this market since June. Okay, you have that downward sloping trend line. If that breaks, the rate of descent or the slope of the decline will no longer be in effect, but that's not where the most bang for your buck is right now. Now, I can take this a step further because K-Web, is it C-Web or is it K-Web, Sean?
It's going to be C-Web.
Yeah, C-Web. I put the wrong one up here. I can actually change that real quick.
Yeah, fine. C-Web.
Yeah, C-Web. K-Web is not the leverage one, but let me just put that up there real quick so you can see it.
Yeah, no problem.
But yeah, we have the I think that's a 2x, or is it a 3x?
That should
2x.
be.
That's a 2x.
Yeah.
Yeah. Let me put that in there real quick. Real quick. All right. Yeah, C-Web. There we go. That's better. Okay, so C-Web. So on this one, what I like about this is, I don't stop just at the country level. I like to be long the strongest sector within the strongest country. So take a look at C-Web here. Okay, I really am bulled up on the tech sector in China. Back in January when we had the DeepSeek release, it actually sent a lot of tech stocks in the U.S. tumbling. It was kind of the big realization that, hey, the U.S. is not the only game in town when it comes to the tech sector. Guys, let's not forget China is the second biggest economy in the world. They have made tremendous strides in the artificial intelligence space, and I would not sleep on C-Web here because I think that the tech sector, the internet sector in China is ripe for the most amount of opportunities. And we see this trending higher, right? Higher highs and higher lows. If you follow my laser pointing here, there was a big resistance zone that we broke around the $50 area that now becomes support. So it's looking very good in the tech side of things over in China. And I would not be surprised if that became a big theme in this market over the next few months. All right, let's shift gears and talk about interest rates a little bit because we just had that rate cut yesterday. What I'm looking at here is actually long-term treasuries. Now we're seeing treasuries sell off some more today. So I think it was a buy the rumor, sell the news type of setup over in the bond market. As a reminder, interest rates move opposite to bond prices, meaning when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. So here too, another triangle breakout that we saw in the 3X Treasury Bull ETF. Again, this is long-term treasuries dated 20 years or more. Now we're coming back on today. All of these charts, by the way, that I have were before we opened up today's session, just to keep things rather simple. So I do see this as a dip buying environment. Now, what we're looking at here is the long-term treasuries 3X bear fund. Now, you broke below what's called an inverted saucer pattern. And, this blue line here is really just to illustrate that pattern a bit more clearly. But that was a support zone. Remember what I said earlier. When support breaks, it becomes resistance. So if you're short bonds right now, wonderful. I would be looking for an exit or looking to book some gains in the $36 to $37 area. And then actually focusing more back on TMF. I think that we want to be buying dips in bonds right now. Interest rates are going lower. How low can they go? Well, I'll just throw this out there. I'm looking at the 30-year treasury yield potentially dropping down to the 3.5% zone. That's about a full percentage point lower than where we are currently. So that also, opens up the possibility of more rate cuts below 3% in the short end of the curve. So I like what's happening here in bonds. I'm a dip buyer on the long in bonds. How about gold, everyone? Gold is having its best year in, I think, around 40 years. Actually, 50 since the 70s. I think it was 1979. Gold's been having its best year. But, I'm not one of those gold bugs. I'm not going to come here and try and scare you and say, hey, guys, pull all your money out of your IRAs and pull all your cash out of the bank and buy a bunch of gold and silver and hide it under your mattress. No. We are here to trade markets. We are here to get the most bang for our buck. And during bull markets in precious metals, in the spot price in gold and silver, you go back in history and you look, you will actually get more bang for your buck owning shares of mining stocks compared to the spot price of gold and silver. Okay, so I'm looking at here the gold miner index. This is the New York Stock Exchange Arca Gold Miner Index, which is the index that Direxion's leveraged mining funds like to track. Okay, so once again, guys, you had this triangle that we broke out for. In this case, it was back in August. That was a pretty powerful breakout. Higher highs and higher lows. You started to go sideways. You coiled into this pattern. You broke out around the apex, which is totally normal. And you continued higher. There's a reason why we call these continuation patterns. Okay, now, do we have a buy the rumor, sell the news setup in gold miners near term? Perhaps. But similar to bonds, I would be looking to buy dips here in gold miners. Now, again, you had that breakout from that triangle. You started to rise within this channel. That is a pretty good sign. That also is a continuation pattern. And, I'd be looking for perhaps some dip buying opportunities in Nugget, as I like to call it, in the 110 area. If we touch this lower trend line, that could be an area to take a swing long on it. But again, you're not holding these for weeks at a time. You're holding these for a few days at a time max. That's how I do it. If you get in, at this lower part of the trend line here and you ride it up over a span of a few days, it can be a very lucrative trade in a short period of time. But if you're on the wrong side of this market, okay, if you're in dust, for example, where there's not a lot of opportunities in the near term, if anything, you might have a little bit of a swing long in the next couple of days, but I'd be looking to sell rips in dust and buy dips in NUGT. So I actually drew this rectangle formation here on dust because, these patterns, the reason why it's so important to learn them is because once you have them in your trading arsenal, they can be applied to any market. So yes, I'm always looking at the index. I'm always aware of what's going on in terms of the trend, in terms of the patterns at the index level. But even when you're looking at these ETFs, okay, look for the patterns, look for the trends for additional confirmation. Again, you're dealing with leverage, guys. This is no joke. I know that as humans, we tend to be optimistic and think that things are always going to work out. But when you're dealing with leverage, you need to be a bit more cautious and definitely pay close attention to the risk side of the equation. So rectangles are similar to triangles in the sense that they are often considered to be continuation pattern. Now, what is the trend here in dust? It's very clearly lower. You see lower lows and lower highs. And then for a period of 2 months, in June and July, you went sideways. You coiled into this rectangle. And then eventually when you broke below support of the pattern, it led to a continuation of the downtrend. So again, I'm in the dip buying camp when it comes to metals, and I'm in the rip, selling the rip camp when it comes to the bear side of the equation in metals. All right, let's talk about a very popular innovation that Direxion came out with, which is the single stock ETFs. I have a handful of single stocks. I just have the actual stock itself on this chart because whether you're bullish or bearish, you have the 2x on the long side, the 1x on the downside to protect yourself. If you're long, if you want to take a bit more of an aggressive stance, you can buy the 2x on the on these individual stocks through the ETFs. But let's start off with Apple. Apple's been a laggard year to date. It has not hit a new all-time high in 2025. And I would say, behind NVIDIA, probably the most important stock in the entire market. I would even include Microsoft in that conversation. But there could be a rotation opportunity brewing here in Apple. You see how we broke out from this saucer pattern back in August, right? There was some resistance there. You broke above it. You came back down. You retested it. That was support. You actually retested it twice. Isn't that something? So I'm not just making this up, guys. I've seen this stuff play out for many, many, many years over and over and over again. Human nature doesn't change. The human condition doesn't change. And it's reflected beautifully in financial markets. That is why these charting techniques works. Okay, and that's why you need to have them in your arsenal as a trader. So what are we dealing with now in Apple? We're coming up onto another very important resistance zone. Let's call it in the 240 to 250 range. You break above that, I don't think there's much stopping Apple from going back to new all-time highs. But again, this is resistance, so if it breaks, it will become support. We also know that right now, there is more supply of sellers than there are demand for buyers in this 240 to 250 range. So that is the big test for Apple. You clear that, then I think you're going to want to own AAPU over AAPD. Okay, that's the way I'm viewing Apple right now. I think it's on the verge of a major, major breakout, and some new leadership within the Magnificent Seven could be on its way. Let's talk about one specific semiconductor stock, that is Micron, because it's been one that has actually lagged. It hasn't really captured the headlines like NVIDIA has as of late. Today, you had the big news between NVIDIA and Intel. NVIDIA looking to take a stake in Intel. Obviously, you have names like Broadcom that have done very well. These are other, ETFs that you can trade on the single stock side here at Direxion. But I want to bring your attention to Micron because I wanted to share with you this cup and handle formation. It's actually one of my favorite patterns to trade because I call it a momentum pattern. Well, what is a momentum pattern? Momentum strategies work very well with these leveraged ETFs. And basically, these are certain patterns that are observed that lead to an acceleration in momentum in the direction of the trend. So did you follow everything I said? Because there was a lot there. One, you need to know the trend. Two, you need to know the type of pattern that you're observing. So the cup and handle usually leads to an expansion or an acceleration in momentum. So whenever I see that pattern forming within an uptrend, I start the bits as a trader. Okay. And so you look for your entry when you close above the resistance line of the pattern, which was right here in the 128, 130 area. And like clockwork, you saw a $30 rally in the price of Micron stock over the span of 2 weeks. That's a big move. And it would have rewarded traders of MUU versus MUD, Moo versus Mud, I guess is how we can call it. I love how you can just come up with these like new slang terms out of the ticker symbols out of these ETFs. It's pretty clever if you ask me. But no, I mean, Again, a little bit extended here near term is the way I see it. You're getting close to some of the targets that I had. I'm not necessarily ready to call it a trade on mud, but it is an example of a textbook breakout that we've seen in this environment. All right, let's talk about a totally different stock from a totally different sector, and it's building out a really notable pattern. It's another cup and handle formation. I'm looking at ExxonMobil. So you have XOMX, the bull 2X side of the market, and you have XOMZ, the bear 1X side of the market for ExxonMobil. And this is in the energy sector. The energy sector was once a large and very feared sector of the S&P 500. I think now it's like worth 2% of the S&P. But Exxon's still a giant in that space. And the reason I wanted to share this one is because we are talking about rate cuts today after the Fed cut rates yesterday. And what does it mean when the Fed cuts rates? It means that they're printing money. They are printing money once again. And what does printing money mean? Well, it opens the door for inflation to make a comeback. Well, where do you think this new money is going to go? Well, I would venture to say that some of it is going to go into commodities. A lot of it's going to go into stocks. A lot of it's going to go into crypto and precious metals and all that good stuff. But some of it absolutely should make its way to commodities. And if some of that makes its way to crude oil, then I would look for stocks like ExxonMobil to break out of their range. And this cup and handle pattern, I'm going to tell you this, guys. This thing gets back above 115, 118. Look out above. You could see a massive rip in ExxonMobil. I'd be keeping a close watch on this, especially with XOMX on the bull side of the market for some 2X exposure on ExxonMobil. All right, NVIDIA, been a darling of this rally, the darling of the Magnificent Seven. Not all rainbows and butterflies. You know, they're dealing with a lot of headwinds right now in China. This is a stock that has in many ways defined this bull market. We see a very clear uptrend here, but I've been talking a lot of the bullish side of the market. I present a bearish case here. Now, I'm not ready to come out here and say buy NVDD and, you know, ditch the ship on NVIDIA. But if you break below this support zone, okay, in NVIDIA, like in the 165 area, you do have what could be a rounding top formation. Now, I want to be clear. These patterns can and do evolve, and it's so important to wait for the actual trigger before acting on them. So very important. We're not trying to front run these patterns. We need to see them actually confirm and play out in order to take the trade. So I'd only be willing to take up NVDD over NVDU if and only if we break below support of this rounding top formation, potential rounding top formation. All right, Google's been a very strong stock, obviously doing some amazing things, not just in AI, but also in the quantum computing side of things. You broke out from this saucer pattern back in late August, early September, and it's just been accelerating to the upside ever since. Would have been a great setup for GGLL. Again, not really keen on calling it a trade for GGLS, but the trend is definitely up in Google. Tesla. This is one where I still think we are early. We have this massive saucer formation here in Tesla, and it's pointing to a significantly higher price if we can break out above this resistance zone. I know Elon Musk has his 420 jokes or whatever, but yeah, the stock is pretty much stuck right there at 425. I think it's getting above there a little bit today. Last I checked, I think we were around 430 before we got on this session. But up against resistance, you break above here, guys. TSLL is not going to be a joke. I did see Lynn in chat earlier saying that she was taking some trades on TSLL. But I would keep that back in I'd keep it in your back pocket because I think it's going to be one that's going to be very rewarding in the coming weeks and months. Palantir has also been a darling of this rally. Higher highs and higher lows. We've seen it's been one of the strongest performing stocks in the S&P 500. Symmetrical triangle. I shared the ascending triangle. The symmetrical triangle also falls into the category of what I like to call the family of triangles. The outcome is largely the same, but you need to break above this downward sloping upper trend line of the pattern. That is, the symmetrical triangle is a continuation pattern, just like the ascending triangle. So a lot of people have been writing off Palantir since that pullback into August. I think it's a little bit exaggerated. I think the trend is still very much strong, but we do need to see a new all-time high in order to reinverse or in order to reinforce the bull trend on Palantir. So PLTU is on the bull side, PLTD on the bear side. Last but not least, to round off the family of triangles discussion, Netflix. Okay, once upon a time, it used to be the FANG versus the Magnificent Seven. Netflix was in that category, but I wanted to share this chart to share with you the descending triangle. It's rather rare, and it's actually a bit of a controversial pattern within the community of technical analysis. Some people don't like to consider descending triangles as continuation patterns within uptrends. However, I've seen plenty of them play out like that over the years. So I'd be looking for a break above this upper trend line, look for some opportunities in NFXL on the bullish side of the equation when it comes to Netflix. And if we do break below this lower trend line here, the support zone around 1150 in Netflix, I think NFXS would be a much better bet. So that's what I had for today. Just to kind of summarize everything that I discussed and summarize some of the things that Sean discussed. Leverage can either be your best friend or your worst enemy. You cannot afford to stay wrong for long. These positions on these leveraged ETFs require consistent monitoring. You need to be looking at them every day, and I would even say intraday. Use price alerts. Know your risk before getting into the trade. Before I take any trade, I have my targets, I have my stops, and I have my entries all articulated. I strongly suggest you do the same thing. But risk management goes beyond that. Sizing your trades properly. Remember that one trade should never be your golden ticket or perceived to be your golden ticket. This is a marathon, not a sprint. I know that these leveraged products can kind of give you a burst of speed, but every sprinter needs to stop every now and then and catch their breath. So that's what I have for today. We do have a couple minutes left here for questions. If you want to stay connected, I'm always going to call it Twitter, guys, Gianni_DePoce. Thank you for joining Sean and myself. Do we have any final questions here in chat before we wrap it up for the day? I'm not seeing any other questions. So I guess that takes care of it. Sean, do you have any final words before we wrap it up for today?
No, once again, thank you all for having us. Gianni, thank you once again for just talking through some of those setups. It's always nice to sit in a room with traders to see how everyone is utilizing our fund. So once again, tactical short-term trading tools for all the traders out there. As I mentioned, our leverage and inverse single stock ETF suite, we're now above 40. When we first launched, we were just with the Mag 7. So there's an appetite there. As you've mentioned, names like Palantir and Tesla, we're seeing inflows within those funds from the Bull 2X side. So for those traders that want to get very granular and trade individual names, definitely check out our website, Direxion.com, and see what we have available for you.
All right. We actually have an encore request. Five Ive is asking, when are you coming back on? Well, hopefully sooner than later. Hopefully before the end of the year.
No, for sure. Thank you. Thank you once again. And we look forward to it.
All right. Thanks again, Sean. And everyone, thanks again for tuning in. Please hit the like button and subscribe to the Benzinga channel. We do these educational types of sessions regularly. It's important to know what you own and know what your goals are with trading anything that you own, whether it's leveraged ETFs, individual stocks, futures, options, crypto, does not matter. There's no refunds in this business, guys. So take every trade carefully. This is a marathon, not a sprint. So thanks again, Sean, and thanks again, everyone, for joining us.
No problem, Gianni. Thank you. See you all.